Thanks for tuning in to this week's investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll go ahead and kick things off with our chart of the week, which really narrows in on one of the more important drivers of the bull market that began in 2022. So this chart here shows the rate of inflation in orange, and it plots the 6-month average of inflation in the black dashed line. Now, this simple indicator, it generates a buy signal when inflation crosses below its average level of the past 6 months. We can see a very timely buy signal at the end of August of 2022. It generates a sell signal when inflation rises meaningfully above its average level of the past 6 months. So we have some wiggle room here on this important indicator, but if the Iranian conflict and tariff pass-throughs start feeding into broad prices, that could remove one of the strongest tailwinds for stocks in this bull market run. So we've been covering the Iranian conflict from a macro and markets perspective, and we can see here why we think oil prices are the primary indicator to watch. True, the Fed watches core inflation, which strips out energy and food, but as this chart shows, core inflation in blue and oil prices in orange tend to have a positive correlation with each other. Higher energy and agriculture costs, if maintained, would very likely funnel through to other inflation categories as well. Now, the relationship between oil and U.S. economic growth has been shifting. The U.S. is now the biggest producer of oil, but before the shale revolution, rising oil prices tended to mean weaker economic growth. But that relationship's been changing. Rising oil prices are no worse than neutral from an economic perspective these days. But we need to remember that the economy and the stock market, they're not the same thing. Energy is currently the smallest sector in the S&P 500 at less than 3.5% of the investable weight. And unfortunately, what's good for energy stocks has tended to be bad for the rest of the market. So this is a busy chart, but it shows annualized returns for the S&P 500 itself when various sectors have been the strongest. Note that when energy has been the best performing sector, that's been the only condition that saw broad market losses. Higher energy prices squeeze consumers and margins for the other businesses in the index. Now, if the conflict were to resolve relatively quickly and the oil supply chain clears up, we would expect that the inflation impulse would be short-lived. That's because productivity is solid and unit labor costs are subdued. So companies don't have much of an inflation issue from a labor perspective, which is the largest line item for most businesses. Now, one thing we've noticed, however, is that for the median business, earnings grew a little over 5% last year on sales of nearly 7%. So that implies that profit margins may no longer be expanding. Margin expansion has been a key fundamental driver of the bull market. So if margin expansion is tapped out, then sales are what matters. And for sales, there's a pretty direct relationship with nominal economic growth. For now, the economy is in expansion mode, but labor market indicators are mixed at best. So we need to watch economic developments here as well. And our reminder is that midterm years do tend to be challenging anyways. Note that the orange line here in this chart, that's the pattern for all midterm years when the presidential party had switched. Weakness tends to persist into the summer before recovering in the second half of the year. Now, often midterm years are challenging because pre-election year stimulus is typically rolling off. But that's not the case this year, as the Fed remains in easing bias and the OBBBA should result in fiscal thrust as well. But it's possible this year's volatility will be more driven by uncertainty over the congressional makeup come November. Currently, Democrats have picked up momentum, as shown in the Texas Senate primary contest and other special elections that have occurred in the last year or so. And as the chart on the right shows, the Iranian conflict is not popular, especially if it lingers. So what we could see is a market that's beginning to discount either a split Congress or fully Democratic Congress. And historically, a Republican president with a check on power has been the most challenging environment for the stock market. Now, in today's comments, we did give several things that are on watch for us, but at the end of the day, two of the most powerful rules that investors can follow are don't fight the tape and don't fight the Fed. All that really means is that we should respect an uptrend and a Fed that is in easing mode. If either of these two things change, we may need to reassess the sustainability of the bull market. For now, both factors are positive. So, wrapping it all up, we need to watch the disinflation trend that's been in place since 2022. A new wave of inflationary pressure could present a market headwind. And though commodity inflation isn't directly measured in broad core inflation, it does eventually funnel into broader prices if it's maintained. We'll watch the length of the Iranian conflict and the physical oil market. If commodities stabilize or ease, then an inflation impulse should be short lived. Energy is not a big sector in the index, and historically, what's been good for energy hasn't been good for the other sectors. So, again, a shorter conflict would be better for the broad market. Another trend we're watching is corporate fundamentals. As long as earnings are growing, the market hasn't typically found itself in too much trouble, but profit margins look like they've stalled out. Midterm years tend to challenge investors. This year, it could be uncertainty over the post November congressional makeup that drives volatility. But for now, we should continue to give the bull market the benefit of the doubt. That's what we have for you today. And as always, I want to thank you for listening and have a great week ahead.